Overreaction and underreaction are psychological biases that influence how investors interpret and respond to new information in the stock market. Both behaviors can lead to mispricing of stocks and market inefficiencies. 1. Overreaction in the stock market. Overreaction occurs when investors respond too strongly to new information, driving stock prices to extremes, often far beyond what is justified by the underlying fundamentals. How it happens: emotional responses. Investors might overreact to news or rumors, whether good or bad, out of fear, excitement, or herd behavior. For instance, when a company reports a slightly disappointing earnings report, investors may panic and sell the stock excessively, pushing the price lower than it should be. Short-term focus. Investors often focus too much on short-term news or events, failing to assess their long-term impact properly. For example, an unexpected CEO resignation might lead to panic selling, despite the company's strong long-term prospects. Market sentiment. In times of heightened emotion, such as during market crashes or rallies, investors can overreact to perceived threats or opportunities, exacerbating price swings. Consequences: price volatility. Overreaction leads to large, abrupt price movements that don't always reflect the true value of the asset. Opportunities for contrarian investors. Investors who can stay calm and focus on the fundamentals may see opportunities to buy undervalued stocks during an overreaction, or sell overvalued stocks before a correction. 2. Underreaction in the stock market. Underreaction is when investors fail to fully respond to new information, causing stock prices to adjust more slowly than they should. This can happen when investors are too cautious or slow to recognize the significance of new data. How it happens: gradual information absorption. Investors may take time to fully digest and act on new information. For example, positive earnings reports or breakthroughs in technology might not immediately translate into higher stock prices if investors are slow to adjust their expectations. Confirmation bias. Investors may underreact because they have preconceived notions about a company or the market, and they seek information that confirms their existing beliefs while ignoring signs that contradict them. Market inertia. Sometimes institutional investors or large market players take time to shift their portfolios, especially if the news is not perceived as urgent. As a result, the stock price adjusts more slowly than it should. Consequences: missed opportunities. If the market is slow to react, early investors might have the chance to buy stocks before they fully reflect the new positive information, leading to potential gains. Inefficiencies in price discovery. Underreaction can prevent stock prices from reaching their fair value promptly, leading to inefficiencies in the market. Summary: overreaction tends to lead to extreme price movements driven by fear or greed, creating buying or selling opportunities for investors who can remain rational. Underreaction results in slow adjustments to new information, allowing savvy investors to capitalize on the lag between new data and its reflection in stock prices. Both overreaction and underreaction highlight the psychological biases in the stock market that can cause prices to deviate from their true value. Recognizing these patterns can help investors make more informed and rational decisions.